Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
So, Scott, we're going to have some back-to-back mics. We actually have two mics, and they're both in the spirit, beverage, alcohol industry, whatever we call it nowadays. I don't know.
Exactly. Yeah, it was really good that we got Mike on the podcast. Mike Solow from 99 Proof. Really fascinating approach to how he invests in the spirits business, and he's in the business all the time, and he had a great investment banking background, so he understands the capital raising opportunity, but he also understands how spirits companies and spirits producers are funded and operated. And not only does he have the opportunity to invest equity, he's got a debt component of what he invests to help people build the facilities. From that standpoint, so he has a really great background in the spirits industry, and he's really one of these value-added investors, because not only can he obviously help these spirits companies grow from a financial standpoint, he has the relationships to get them distribution, partnerships, and other opportunities. So it really is an all-inclusive approach to helping people move forward in the spirits industry. And as an Irishman, I always enjoy a good cocktail, and if I can get some free alcohol from time to time, why not do that too? So.
Yeah, so let's schmooze a little more on our show here. I love it. Well, Mike Solow is the co-founder of 99 Proof. He brings over 20 years of experience in business development and sales leadership, and he focuses on growth and scaling organizations. He's successfully started and grown multiple companies, trained high-performing sales teams, and is a trusted advisor to C-level executives. Mike's background also includes mentoring over 200 entrepreneurs across the U.S., so he understands this sort of small start and startup model. And let's hear from Mike, because he's got a great story.
Well, hello, everybody. My name is Scott Kelly. I am the founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And I'm excited to have an investor on today, which is something I have some background in, the spirit space. But Mike from 99 Proof. Mike, welcome to the podcast.
Thanks, Scott. Glad to be here. Thanks for having me.
So before we get started, and before we get to the fund, give me a little bit of background about yourself. How did tell me what you did before you started the fund, and how you came to find and found 99 Proof.
Sure. Yeah. Bit of a winding road heading into to launching 99 Proof, but my original training, even all the way back to coming out of college, was in business development, sales leadership, kind of like culture and training as well. And I started an advisory service that worked with smaller businesses and startups with a partner that I still have to this day at 99 Proof. So he and I worked with smaller companies, sort of management consulting style, if you will. So we focused on process, people, and tools, but it was all about driving top line revenue, making sales forces perform better, close bigger deals faster, bigger, better, and so on. Right. So that work landed us inside of an investment firm here in Dallas, and an investment bank here in Dallas, and the general thesis there was, again, just do that kind of work, but just for bank clients that are either in the capital raise arm or heading towards an M&A event, work with them for a bit, and hopefully, in the M&A team, they could get another half a turn or full turn as part of our cycle in the process. There was also a restructuring team that would bring us in to theoretically stop the free fall on the revenue side, and hopefully avoid a bank asset style transaction, and kind of get things headed out in the right direction. So along the way, myself and my partners, we had been exploring working in beverage alcohol more and more. Back to the pre-investment bank days, we had taken on some advisory clients and served on their board and so on, in the beverage alcohol sector, and really kind of a passion play. We enjoyed it every step that we took. We're all drinkers, so that doesn't hurt either. And so when we found ourselves at the bank, we found ourselves sitting in the room, let's say with the capital raise team, and on one side, there's, a family office who's considering a meaningful investment in at least one or maybe several small beverage alcohol companies. And on the other side of the table, the leadership from those companies really didn't understand how to talk to them, and vice versa. The family offices, loved the sector. This is post George Clooney exit. So, they saw what was possible, but, they weren't really wanting to dedicate internal resources towards figuring out this sector. It's not healthcare, it's not tech, it's big, but it's not that big, right? So, and it's also fun, but if you're not good at fun doesn't pay the bills. So, they started looking to us because we were in the weeds, working in this sector and at the leadership level and helping these companies expand and so on. And so we started, being that conduit between the leadership and the potential investor. And so, circa late 18, early 2019, we started putting together deals, deal by deal, SPV style. And that's what 99 Proof ended up becoming, was sort of this patched together, thesis of advisory and capital. And so we didn't raise a dedicated fund. We stayed with the SPV style, and today we work with just over 500 accredited investors, high net worth individuals, family offices. Though mostly it would be, at least on our side, folks that are stepping out of the office and kind of investing on their own, and almost like retail style investing, and then. We see on the deal side, on the deal flow side, we're lucky enough to have a really deep network in the sector now. The way that we built 99 Proof is by doing what we feel is good work. And so we didn't spend a ton of money on marketing. We just started working with people and being a true value add and helping companies grow and being able to deploy meaningful capital and then supporting them after the fact. And that's how our name got out there. So, we get deals sent to us by the largest firms, in the investment sector as a whole, including, outside of beverage alcohol. And then, there's single small investment banks, or investment bankers, single shingle guys, send us deals too. And so we have a ton of opportunities to invest in this sector, and it's a great time to do so. And also, along the way, we determined that there are some ancillary, like non-brand style investing opportunities. And so we've developed a follow-on fund called Cask Strength, which is a private debt style fund to deploy more towards the manufacturing side of our sector.
So let's break that down a little bit. So talk to me about the fund thesis. Obviously, the spirit space and the food and beverage space has a lot of sizzle out there, a lot of opportunities, but talk to me about, obviously getting a lot of deal flow. How are you deploying that capital? Give me an example of the types of entrepreneurs that you back, and, what's the average check size? What do you look for in management? Talk about that a little bit.
Sure. So on the 99 Proof side, I'll save the debt conversation for last. So on the 99 Proof side, our original fund thesis was somewhere between 4 and 5 years is the exit timeline. We definitely are looking at smaller, sort of earlier stage businesses, and we need to give them enough airspace to kind of grow and get to the point where an exit is realistic. Important for people to know that maybe don't understand much about beverage alcohol yet is. In this sector, that looks like a very small company to folks that are not from this sector. So a medium-sized beverage alcohol company might be in the $10 million range, and in other sectors, $10 million is basically a startup, right? So it's just important to understand that. Also important to understand that most of the costs in this sector are front-loaded. So you have to make something, age it for a while, if it's a brown spirit, and then you can bring it out and make money on it, right? And so there's inherent challenges with that as a business model. And so our investment thesis really across both funds really is targeted to this sector to help them overcome those inherent challenges. So I've been back to the fund thesis. We invest in traditional brand equity, so standard private equity style investing. We do debt and real estate as well through 99 Proof. And so real estate, that might be something along the lines of a rick house expansion, or putting down a tasting room, attached to a distillery. And then when I say brand, it's just important for people to understand that's a traditional private equity investment. You're on the cap table and just trying to grow the company as a whole. A brand in our sector is something that sits on the liquor store and on the shelf at the liquor store and has a label.
Sure.
So, Jack Daniel's is a brand, so you can invest in brands that way. And then debt is pretty specialized in our sector as well. It's mostly aligned with barrel aging. So if you're a bourbon company, a brown spirits company, and you have to age your product a certain number of days, weeks, months, or years prior to putting it in a bottle and bringing it out to market, then that is an appreciating asset, and so you can get debt deals done on those types of assets. So we do all those things, and then on the private debt fund, cask strength, we only do that barrel lending style investment. We work specifically with distilleries there. Much less brand work and much more producer style work.
So talk to me what from a founder perspective. Are you working with new founders trying to bring out a new craft distillery or a new brewery or a new concept? Or are you working with seasoned founders? What's your criteria? From once you got a good deck, what else do you need?
Right. So we're definitely post friends and family investors. In today's world, there's a lot of opportunities to invest in this sector. And, for us representing seasoned investors and folks really that are just trying to diversify into this sector for the first time, we have to be pretty careful about the genetic makeup of the leadership teams that we invest in. So, for us, we're definitely looking for seasoned vets, folks that maybe this is their first foray into, running their own business, but they understand this industry. That is probably the lowest level of like business ownership acumen that we'll get involved with. There are definitely multiple time founders that we've invested in, and really we're looking for the stereotypical like seasoned leadership team, the studs that are being brought in off the bench or being taken out of the strategic companies in our sector and kind of stepping out and doing their own thing now. That's definitely more attractive for our type of investor, which ultimately is who we serve, who we work for. It's just, especially with the economic constraints of today. And investor confidence being what it is, we have to be highly in tune with how investors are thinking and feeling. And so, for us to bring a leadership team that has solid credentials, a nice long resume, successes in the sector, lots of relationships to build upon, up to and including, relationships at that eventual acquirer. Those are all definitely boxes that we want to get checked.
So you mentioned George Clooney. It's interesting you say that because I've worked with several celebrities, influencers, athletes that get into the spirit space because it's a fun business and they attach their name to it. So talk to me about how valuable that is, and then how does that move the needle in terms of getting shelf space? Because obviously on the distribution side, getting distribution is one thing. Getting it on an end cap and moving the product is a totally different thing. So maybe share about those two pieces of the business.
Sure. And I think you hit it on the head really with the question. Maybe prior to getting into that though, yes, a celebrity can be a massive advantage for a brand, but it can also sink the entire thing too. So, we talk about it in terms of authenticity. So if you have this, potential partnership, it really needs to be born out of from at least from the celebrity standpoint, a love for the product, a love for the brand, a love for this sector, and really be like, if it's going to be a bourbon partnership, that celebrity needs to drink bourbon, not
Right.
only just be a consumer, but to really know a good amount about it, because they're going to be out there talking about it. They're going to be interfacing with people who, specifically with bourbon and tequila, they maybe know more than anybody. The consumer knows maybe more than anybody about producing those types of spirits now.
Right.
You have
Right.
folks that camp out in front of the liquor store for 2 or 3 days in advance of a product launch, almost like it's a rock concert, right? So you really have to have an authentic mouthpiece to attach to the company. And if not, then it really does fall flat. Regardless of how big the celebrity is, or how often they're making posts or doing interviews or bringing it on TV or putting it in movies, or whatever their initiatives have been laid out, it doesn't work if
Right.
they don't have that sort of authentic foundation to stabilize the partnership. From there, we definitely want to see those individuals become an investor, even if they're not upfront. We want to see them become an investor in the company, more than just their time, but
Right.
with their money, with their hard-earned money, and really get in alignment with the remainder of the cap table, the leadership team, and get this thing headed towards the exit trajectory that everybody's hoping for. And so, the celebrity can be a huge advantage for a company, because you mentioned end cap, you mentioned sort of getting eyes on a product or standing out amongst a very crowded field. That can kind of get them up out of this 1,000 brand kind of competitive
Right.
sector, and get it up here where there's really only 10 or 15 that have that amount of visibility. And then that's a great tool, as long as all of the aforementioned
Right.
has been accomplished, right? And so we often do see brands that are kind of trying to get into it too fast, or haven't really thought about that style of a partnership through that lens, at least. And that's a big red flag. I mean, it's really hard to convince somebody on the investor end who doesn't know the founders that well, and maybe they're a consumer of that type of liquid, but then they're going to make an investment in this company and kind of tie the future success of this company to this massive, very visible human being.
Right.
In our chair, we have to convince them that this is a smart partnership too.
Right.
And so thinking
But it's
about
interesting you say that.
point,
It's interesting you say that, because years ago I was involved in a winery. I won't mention the name, but he was a very famous race driver, multi champion, and he simply just put his name and autograph on a bottle of very bad wine out of Northern California. And again, I think it's part of it. Obviously, can you turn a $9 bottle of wine into a $100 bottle of wine with a photo? Maybe, but is it a good business model going forward? So I appreciate that input. Let's talk about trends. Obviously, I'm in my 60s. I had a few vodkas last night. I love a good tequila and a good wine. But it seems like, and you probably follow this very closely, the younger generation are becoming less alcohol consumers and maybe consumers of other kinds of beverages. Talk about kind of trends of where you see, the place, things that are going well and the things that could be a challenge.
Yeah. So, I'll start with sort of the salacious end of it, and then I'll hopefully provide you with a more meaningful answer too. So on the salacious, this industry takes a long time to perform. So we're still seeing things in our sector that are sort of specters of the semi-catastrophe that came out of COVID, right? And so at the time when things opened back up, there was massive reordering, and revenues went like this, and everybody thought this was the new normal. And very few people were able to step out at up to a higher level and recognize that this was a very small bubble that would eventually normalize once warehouses were refilled, store shelves were refilled, restaurants had what they needed in order to do business. And in fact, that was not forecasted very well. And what ended up happening was the system got choked at the consumer level, whether it's a restaurant or at the retail level. and then that backs up into the distribution level. So the warehouses that are full of the refillable products, right? So when the restaurant runs out, the distribution company has to make a delivery. So those got backed up, and then that backed up on suppliers. And so it just takes a lot of time to unclog the machine. So the trend from last year was, oh God, alcohol is down. It's the first time in however long, decades that alcohol is down and blah, blah, blah. And then now, this year, everybody's saying that alcohol is going to be at least back to normal, which was somewhere between 2 and 3%, depends on who you read, combined annual growth rate on almost on a set it and forget it annual basis. So we're certainly seeing that too. We're seeing kind of things normalize. Again, kind of depends on who you read, but we're certainly seeing that in terms of the reporting from the companies that we made investments in and the things that they're reading, and as well backing up our general thesis. So that's kind of macro trend number one. You mentioned some things around the consumer base that are also kind of important to unpack too. So taking the younger demographics, there's been a lot made about non-alcoholic drinking, slowing down of drinking, and this overarching trend of premiumization. And I would say in today's market, they're almost all related at this point. You used to be able to kind of evaluate them independently, but now, who doesn't like a better quality cocktail, right? Yeah. And the prices of the higher quality ingredients are coming down a bit right now too. Inflation and other market trends rearing their head there. And so this concept of premiumization is happening all over the place. It's happening in the cheaper drinking segments, like in the seltzer-based stuff that you can, get in a can, and now you see, kind of prices going up a little bit there, but the overall quality of the components of those cocktails are going up, and then you're seeing this younger segment of the market that's maybe coming out of drinking that stuff and getting into more like high quality cocktail style environments, mixology bars, and so on. You're seeing them much more apt to go to those types of locations or to produce, even if at home, those types of cocktails. And so what we're seeing in the younger demographic is not necessarily this regression in terms of drinking, but it's definitely an increase in the quality of what they're drinking. Now, again, kind of coming out of COVID and over the last maybe 24 months, a lot has been made that demographic isn't drinking as much. And now we're seeing some reporting coming out that they actually are. So, again, it depends on who you read. I would say just for the average consumer that, maybe is listening to this podcast and is going to go out and do a little reading on their own, the overarching thesis is that alcohol is not going away. This has been a part of our culture for a very, very long time. And multiple evolutions of it, in fact. And really what we're seeing is just a reinvention, a reinvigoration of the thought processes around what drives somebody to the bar. It's much more in alignment with, pairing the right things with the right meal or the right occasion. Right. And there's a high degree of experiential factors that kind of go into the decision making that consumers have today. And I think that's great. I think it kind of makes a lot of room in this sector for a lot of different offerings, and it brings people into it too, more on the culinary end of things. So it's an exciting time to.
It seems like generationally people are moving away from Pat's Blue Ribbon and like Goldschlager and moving to higher quality product.
Yeah, absolutely. Tequila is a great example of that. Anybody that drinks tequila, you mentioned it, it used to be the worm in the bottle and, lick it, slam it, suck it shots at the bar. And it very much is a sipping environment now. You can drink tequila neat and have a great experience. And there's a lot of craft in the production end now. So, there's a lot of white space in this environment right now. A lot of growth opportunities.
So share. We're going to kind of pivot and kind of talk to potential investors. So first of all, why don't you share some success stories? Talk about some brands that you backed and are doing some great things.
Yeah. So we're still by the book at least. We're still a pretty young fund, And so, investing on that 5-year turnaround, we're just now poised to see some exits on the equity side.
Okay.
All but one of our debt deals has paid out. And so, those are obviously much more programmatic and,
Right.
black and white in terms of how they perform, how they work. So the debt investments have been a great way to stabilize on our end. A couple of brands out there that are doing really well. We invested in the tequila side in a company called Siempre Tequila, which is doing really, really well. I can tell you, back to the how do you evaluate what you're gonna bring out to your investors. We definitely loved the liquid on this. It's a great product. They take a lot of time. The distillery takes a lot of time producing what they produce, and then there's some higher end offerings that are a little harder to replicate and unique within the marketplace that we also saw added some really good value to the brand. It's not a celebrity brand. Maybe they do go that route in the future, but as far as their forecast goes, that's not really part of the plan. So it's just the ground and pound, the grind of selling even a great liquid, is still pretty difficult in this sector. But they've figured out great partnerships and are doing really well. We had a great degree of success, of belief in both the founders and the leadership team. They're a very gritty group, and it's important that people know, like, this is not easy. Even with the celebrity brands, it's a grind. And it's not, this is not a platinum coated, very shiny environment. You've got to roll up your sleeves, get out there and get your boots dirty. And so these guys are really good at doing that. We made another investment in a segment. I bring this up because it's a segment that personally we thought we weren't really going to get into. But wine, this is a couple of years ago now, but wine reinvented itself in terms of how it's delivered to people. And so now you see, in addition to just bottles, whether they're dusty or shiny, but there's also boxes of wine now. That good wine, not the stuff that was out there 10 or 15 years ago. You've got wine in cans and wine in this and wine in that. And so early in that segment, we recognized that was probably going to be a growth category within the wine segment. And so we invested in a company called Archer Roos, which produces wine in a can. They have a special IP around the inside of the can itself that protects the quality of the wine. And they're sourcing wine from great regions. They're putting really good, very approachable wines in a can. And so they basically are just dividing a bottle up into a certain number of cans. And that's what you get in your, your purchase. And it's doing very well. And they are one, converse to the Siempre thesis, they are one that has a celebrity partnership. It's done exceedingly well, maybe one of the best, at least that I've seen. The celebrity is an investor. She participates in the brand on a very, very consistent basis. She designs some of the creative stuff that comes out there. She almost functions as their chief creative officer. And whenever she's on TV, she puts it in front of people as well. So it has that very organic, kind of feel to the partnership. And then she's also very funny. And so I find that to be, a fun, plus as far as the partnership goes. And so that's one that's gone exceedingly well for us as well. So, there's a lot to be excited about in this sector. I think, I would be remiss if I didn't say that, given what's happened to pricing within the sector, which maybe dovetails on another question that you were kind of alluding to earlier, about the timing of making investments here, and why now almost. What's happened recently coming out of COVID when the system got choked up that I kind of alluded to earlier, is a lot of price correction. And, when things were really flying high, especially coming out of COVID, there was a lot of increase in price, certainly on the supply side. Barrels of bourbon went up, 2x and so on. And that's come down to at least to the level that it is today. And it's a fantastic time to be an investor in this space. The type of value that you can get as an investor is insane. So, it's
talk about that. Why is the value, why is the timing insane now? What's happening? and what's going to happen that's going to make it a great opportunity down the line?
Yeah. So, standard economics, you don't buy high and sell low,
Sure.
right? It's the converse. So that's where we are right now. I'll use bourbon as the example because there was a Forbes article that sort of went viral a little while ago, talking about bourbon values, bourbon barrels. So, just to kind of catch up anybody that doesn't know, so bourbon barrels were trading at a very high rate on a per barrel cost. So once bourbon gets to 2 years or so in age, it can be blended and put into a bottle with older stuff. But generally speaking, 4 years is kind of the line that people want to age their bourbon to. So, on the debt side, that's 4 years with very limited revenue, right? So that's why we do what we do on the debt side with distilleries. But so those 4-year-old barrels were trading at pretty high rates coming out of COVID, and those values have come crashing back down to reality. Now, the deal is, though, they're not really going much lower, if at all.
Gotcha. Yep.
So we're conceptually at the trough, maybe coming out of it. It depends on who you read, but rough order of magnitude, we're at that V where things start to come back up. Even if it doesn't come back up to where it was and it stabilizes, you're still investing at a high value segment in the market. Even at baseline, it is still an appreciating asset. The problem is people got into it when the price per barrel was up here, and now the price per barrel to produce new liquid is down here. So there's still going to be some more correction, I think, there, and some folks are kind of in a distressed sale environment with some of their assets there. But that's a microcosm of what's going on. Valuations have come back down on the equity side because there's so many companies that are raising money right now, again, because of this choke that happened in our system that's just now getting worked out, that you don't have to pay as an investor ridiculous valuations to get into these companies. And so there's a lot. It's a great time. I mean, you see Warren Buffett got into it recently. I challenge anybody to argue with that guy. So, there's a lot of positives. Again, fully acknowledging this is always going to be a diversification play, right? You're not going to hang your entire portfolio in the beverage alcohol sector. And we recognize that. But for the folks that do have the luxury to diversify, this is a great place to diversify. And it can be exciting and tons of fun too, and
awesome.
Experiential and all of that stuff.
So let's talk about the fund itself. Obviously, you have your fund down there. You're still obviously bringing in potential LPs. So give me a breakdown of who these potential LPs are and who is the additional ideal LP, and what kind of investment dollars are you taking in currently?
Yeah. So two different answers to that. On the debt fund, again, I'll say that for the latter segment. On 99 Proof, it's a bit more of an open door, which is why I start there. So as a fund, our floor investment is very low. We will work with investors that can dedicate $25,000 to an investment and up and up and up. We have investors that are cutting much larger checks than that, but we're fully open to working with investors that are just now kind of dipping a toe into this segment, or even into diversification as a whole. We take a lot of time to work with them, educate them on the space, definitely relevant to the investment that's coming out. And then, tons of phone calls and literature and stuff that we can give them to get up to speed fast. Average check size across the firm is around $500,000 into the smaller companies. The largest that we'll do is about 1.5. We did a little bit more than that into one of the investments we made. But by definition, we're a minority interest shop. And then from there, we do participate fairly actively post-investment. So, any of the, considerable resources that us or our, network has, we sort of open the Rolodex, if you will, and let companies take advantage of any connection to, capital or sales force or marketing teams or, whatever it is that we have in order to help them grow. So that's on the 99 Proof side. And that's, again, that's brand equity, that's debt, that's real estate. Now, the specific debt fund is larger. So, on average, we're looking to deploy a couple $1 million each time we deploy, and up from there into the 10 to 15 million range, and even up a little bit from there. So those deals are much more specific, much more programmatic. They do last arguably as long. So if you think of a barrel aging program that's going to include new fill, which is stuff that comes right out of the machinery into a barrel, goes to age, most of the stuff that's out there in the bourbon sector, you're going to be looking at a 4-year aging period. Tequila is less. It's a couple of years for añejo to get to the 1 year to get to the añejo point. But even there, a lot of the distilleries will age at another half a year, for quality and taste complexity. And then if you're doing reposado, it's less than a year, but nonetheless, the turns are quicker on the tequila side. But we approach these programs in terms of stabilizing a distillery. And so what that looks like is a distillery may be in hyper growth mode and taking on big clients that are maybe starting with smaller orders, but they're going to grow those orders over a 1 to 2 year period of time. That'll really distress the distillery. They have to have enough liquid, backed up in aging already in order to service that need where that large client is starting to make these massive orders. And so our specific debt facility there is designed around backing up that inventory that's been promised and allowing them to also grow it so they can service the future needs of that and hopefully more customers. So do
you find with some of these companies you invest both on the equity and debt side, or is it either or proposition?
It's becoming a both proposition more and more. Okay. It depends on what they're producing, right? So most of the clear liquids out there, those are very quick, right? So you don't really need, at least that style of debt, you don't really need it. That there is kind of the need for PO financing and some things that have been out there for a long time, but that specialized piece that we bring out with cask strength that's able to be, kind of flexible and easy to work with during that dry period where revenues are thin. That's pretty hard to do, but we've figured out a pretty key unlock on that side. So, so on the brand side, there's definitely PO financing needs. We see that more in stuff that's going in cans, things that are moving a lot of weight, but a lot of companies just as a whole are interested in at least some kind of, line of credit style. Right. So there's a lot of debt in this space.
Okay. Yeah, absolutely. So what are some any final thoughts or information you want to share with our listeners today?
Yeah, I mean, I think just overarching thoughts are more tied to that this sector is definitely worth further exploration. It can produce very meaningful returns. It's important to come into it with clear eyes that it's not a tomorrow kind of return. It's not going to be a salacious, tech product or, healthcare product that is here today and sold tomorrow. Our debt deals produce very repeatable, almost drumbeat style investor paybacks. And so if that's what they're interested in, then this sector can provide that too. But it's also, again, very fun and experiential. And this is the kind of thing that you can, see at parties at your house. You can see people kind of getting behind the product. And so that's always fun too, right? It's hard to, get your friends to support the new
drug company.
Right? So it has that sort of underlying asset going for it, which is just the funness that surrounds the sector, and because it is a diversification play, again, important to give enough airtime to that topic. It's a diversification play. So it is important that some of these other things that you don't use to evaluate your healthcare environment, your healthcare investments, your real estate investments, mostly not that fun. But, this is also fun while being high performing. And so it's definitely worth, my opinion, further exploration. That's what got us into this from investment banking. That was, concentrating on deals across all different business sectors, at least in the U.S. And so there's also a lot of opinion and stuff out there. And
Right.
so, finding folks like my team and folks that have been doing this for a while, I think is key, especially prior to deploying your first check into this segment. And I think because it is such a get around the bar, tell your stories kind of handshake environment, that most folks will take your call and will, spend 30 minutes, over a virtual coffee, just talking to you about the sector and giving you some stuff to read. So you can start to fill up your knowledge base before you get involved. So that would be just kind of my takeaways there. Outside of that, it's a great place for returns too.
No, I appreciate that. I don't think I've ever invited someone to come over for a dinner party and show them a cybersecurity startup. It was always a sample of the latest wine or something else we bought. So I definitely empathize with that philosophy. So Mike, where can they learn more about 99 Proof and Cast Ventures and yourself?
Yeah, so I would say the easiest place is 99 Proof's website. So that's the number 99-proof.com. They can go to LinkedIn. I'm pretty active on LinkedIn as well, and just connect with me there. And I know you've got that link. Outside of that, Cast Strength is not something that we advertise. Some people would probably call me an idiot for that, but it's the type of situation that we want to be very strategic about where we deploy those investments. And so those kind of rely more on our relationships with distilleries already. And so
Gotcha.
We don't necessarily need to create a big online presence around that, that environment. But 99 Proof does. And so that's a great place to start. It talks a bit on our site about our thesis, and we've got backgrounds on there as well. But then from there, if they want to connect with me on LinkedIn or just, fill out the contact me deal on our website, then we can set up a call and go from there.
Fantastic. Mike, thanks again for being on the podcast. For all you listening today, make sure you check out 99 Proof online and Mike on LinkedIn. And I'll close with saying cheers and good luck to you, Mike. Thanks for being on the podcast today.
Thanks, Scott. Cheers, everyone.
Scott, when you were saying at the beginning about how they have debt structures and kind of different models of structures, what I really got here, what's so interesting is that this reminds me a lot of the e-commerce space, where you had a lot of small brands who were just waiting for a bigger structure to take them over, a bigger brand to take them over. So you've got a lot of that can happen to your brands. So there's a lot of places to move them. Or you go deeper and you build a whole infrastructure and you build the next big beverage, right? So I think that's really an interesting model. They have a lot of room.
He can hit the financing for these spirits entrepreneurs from a couple of different angles. Obviously, he can invest on the equity side with the spirits. If people want to build the facility, he's got the ability to help them on the debt financing side. And the really thing that was fascinating, the learning about how you value the cask where you ferment the spirits and how it gains value over time. And you can finance that increase in value with the cask, and which I thought was really fascinating. And and so he has a really great approach to solving the problem of funding, not just trying to put a square peg in a round hole, which I thought was a great way to handle this. In a very competitive spirits industry.
Well, very competitive, but also I think it has its place for small startups. And so that's what's so great about, this sort of founder mentality that he understands and can mentor, is that there needs to be this broad taste and this broad shakeup from time to time. You can't just have these giant companies controlling everything in the spirits industry. It's not fun.
No, exactly. And to that point, I had Mike speak to a founder, of a small spirits company here in Florida. And what they have is they have a great product, but they have a great community of fans. And so the reality is it's an opportunity to take a great small entity and give them the financial wherewithal to expand, on a larger scale. So it was really good to have a conversation with him because he understands the specialty small niche of spirits, not just the monolithic, spirits and alcohol providers, that everyone knows.
So beyond a good drink here, which I have an Irish background and Italian background. So my dad used to make wine in our garage. And he made wine from strawberries and won a California award. So like I get how that industry has this cottage industry of passionate people making things. But how is it from an investment market? Like, you've mentioned that you have a couple of investments in that area. So what's going on in that marketplace from an investment side?
It's competitive, and obviously branding is important. Having a good product is maybe half of the battle. It really comes down to getting shelf space. Getting that end cap is a big financial burden that most people, when they're new in the industry, don't realize. It is, in some respects, it still is a pay to play opportunity in terms of getting into retail. So, to have someone who not only has the opportunity to finance the entity correctly, but to build the opportunity through relationships to get that, all important shelf space. And it is competitive. It's like, you go into a liquor store here in Florida, you go to a Publix, and there's God knows how many bottles of wine. And, I go to Publix, I pick the one where it's 2 for 1. I'm not necessarily a connoisseur, but there are people that are connoisseurs and really want that quality. But quality doesn't necessarily always get on the shelf. And I think having that ability to handle the finance side of it, but having these relationships nationally, internationally, that they get that exposure, get that brand awareness, and ultimately get that shelf space is important.
It's not just the big brand shelf space, right? I mean, you obviously want that as you go into bigger and bigger circulation, but the beverage industry in general, or the alcoholic beverage industry, because of state-by-state controls, the liquor shops are still in control of things. And that means you've got a good local person who's recommending things. So there's all these layers to the distribution, and that has always surprised me that it hasn't consolidated, even though we do have big national Bevmart style chains, right?
Honestly, I owned a craft brewery back in the day, and the model was build to a certain size, and then you get the name brands take you out, and that's what happened with us. And that's not necessarily always the path to greatness. And the reality is, if you can build something, you can have a very successful craft brewery and craft spirits business in a region and be extremely profitable. And I always tell everybody, many years ago, I was in the music business, and, the radio promoters would brag about getting you 80 spins in 52 markets. And so that's like 3 spins in Montana, which no one, with respect to Montana, people don't care much about that. If you can build a concentrated fan base, you can expand from that. And I think, Mike understands that struggle of being, be the best in your backyard first, and then conquer the rest of the world. And I think his approach and how he helps these craft spirits and liquor brands accomplish that goal, along with accomplish the funding goal, I think is really critical and again, a very, very competitive industry.
And, I was just thinking, because we've got the 2 mics, so we've got another mic coming up on our next episode. But I was thinking, how is 99 Proof different? And one of the things that, besides being able to help at a lower level or at a more startup level with the brand itself, he also has a lower threshold for investment, which I think, so if you're dabbling into investment and it's kind of your first time joining a fund, joining something that you maybe have a personal interest in, and it's not a huge outlay for you, is an easy ask.
And that's where he's really relying on his past investment banking experience. He corrals a group of people to invest, and it's more or less kind of an SPV, special purpose vehicle model, but it's really a controlled model that has worked several times in the past, and it seems to be working going forward.
Well, Mike Solow, 99 Proof, great one. We're going to have another Mike coming up. Mike Warren's coming up, and we'll kind of look at it from another angle next week.
Thanks.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guest next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.